perhaps one bright spot here is that middle market where a lot of private equity activity is happening and expected to rebound next year. What does that pipeline look like, Rob?
So the pipeline for next year looks much improved. The private capital markets or the middle market were not unscathed by the slowdown or the air coming out of the balloon a bit after record 2021 and 2022. But there is some cause for optimism in 2024.
Now, if you think about the optimism, one thing I wonder about is where the money comes from. And rates are still quite high. Yes, things are starting to stabilize. They're higher than they've been in the last decade, really. And private credit, while that has been an interesting channel the last year, there is an expectation that even their defaults will start to tick up a little bit. Is capital as available as it seems on the surface?
Yeah, I think capital availability is less of the issue. I think there is lots of dry powder sitting in the private equity world. There's lots of cash sitting on corporate balance sheets. And as you point out, the private credit markets have a good deal of capital to put to work. The issue is more value. I think as the cost of capital rose more rapidly than anybody expected, it had an effect on values. And it's just economic theory. When the cost of capital goes up, values come down, and markets take some time to react to that. So it's a bit of a stare down between buyers and sellers right now, with some external forces, putting pressure on both returning capital and putting capital to work.
Yeah, exactly, Rob. I mean, we've seen a lot of, particularly in private equity, a lot of write-downs and a lot of sort of, revaluations of stuff that's already on the books. How are companies valuing themselves these days? What kind of metrics are most important?
So there's two things they look at. They look at fundamental performance, which has held up very well. I mean, we're not seeing widespread business performance issues either at the top line or the bottom line, really across any sector. So when we look at the private capital markets, business performance has been relatively good. The issue has been multiples. And as I said, as the cost of capital has gone up, the multiples have come down a bit. Now, you also have to put this in context that a lot of private equity groups, they didn't write their assets way up when the market the public markets were moving materially up. And so they have further to write down. But I agree with you. I think there is going to be an ongoing kind of revaluation of some assets sitting in private equity.
Now, you're actually looking outside the United States as well. And I know countries like India, Singapore, and Vietnam are very interesting to you right now. Why is that? I mean, we've seen a run up in India already just in regular market valuations. Is that part of the reason?
That's part of it. I think India is a particularly strong beneficiary of people wanting to de-risk economically from China. And I think there's a view that whatever geopolitical tensions there are with China are likely not going away soon. And while China will always be an important economy, many Western companies are looking for alternatives. And in India, it's the largest democracy on earth. It's largely based in English and in English common law. And so we have a very large and successful office in India. In fact, we did an acquisition earlier this year. And we're seeing increased economic activity there just because it's a higher growth economy. But also, I think looking around the globe for companies that were in China, where else can they go? India is a big beneficiary of that.
There's a lot of uncertainty around China, including geopolitical uncertainty. There's a lot of geopolitical uncertainty in the Middle East, where a lot of financing has come from in recent years. How much does that have the potential to throw a wrench in some of the optimism we're seeing into next year?
I think less on the financing front. I think a lot of the sovereign wealth money has made its way into private equity groups. That's committed capital already. There are direct investments, and maybe those slow down a bit. I think the bigger issue is on the macro economic front. I think one of the things that happened this year is we are starting to see a pickup in activity in Q3, and then the crisis in the Middle East happened, and it just, as people were just starting to maybe be a little more risk on. That came onto the geopolitical stage. And I think the fear is that the U.S. and other countries get pulled into something more broadly. So I think that effect potentially, it's a little bit of a black swan event, but that potentially has a bigger effect than at least in our markets, financing out of the Middle East, just because a lot of that is already committed through global private equity funds.
So what about this idea of private equity? You had mentioned earlier buyers and sellers and meeting in the middle here in terms of negotiating. How much power does the seller have in this market, given what we're seeing in terms of compression of valuations?
Yeah, I think the seller has less leverage. I think, and that's part of just it takes time for maybe sellers to realize not only what's the current valuation market, but what's their leverage. And I think you're coming off of many, many years where the sellers had all the leverage. They had highly competitive processes. They had multiple bidders at very high values. And if you blink, they just go on to the next bidder. And that has changed a bit. I think buyers, even if they're willing to pay the price that a seller wants, the buyers have more leverage. They can dictate timing. They can dictate structure a bit more. They can dictate what they're going to do in due diligence. So I do think that, and interestingly, we did a survey of thousands of private equity groups, and we just got the results back. And over 70%, I think it was 72%, feel that this bid ask between the buyers and sellers is going to continue to rectify, and that you could see an opening up of the floodgates in the back half of 2024. So I do think that if anyone blinks first here, I think it's going to be the sellers, not the buyers.
Yeah, I was just going to ask about that survey, Rob, because why the second half? I mean, we've had bank CEOs promise for a return of M&A activity for a couple of quarters now. Is it not going to happen until the Fed starts cutting rates, or what will be the catalyst?
I think you will see an improvement even in the first half, but I think what you tend to see in our market is it's not linear growth. It's kind of an exponential growth. And once buyers and sellers start seeing activity pick up, they kind of flood back to the market. So I do believe as things have stabilized and the fear of a deep recession has passed and the fear of further interest rates increases have passed, you are going to see an increase in activity throughout the year. I think what's expected is a real acceleration of it in the back half of the year.